Shares of Signet, which is the owner of Kay Jewelers, Zales, and Jared, a little bit lower today. The company released preliminary numbers. Year over year, the company saw holiday sales surging more than 30%. Same-store sales up 25%. The company also raising its fiscal year 2022 sales forecast to $7.78 billion. That's $300 million more than the high end of its prior outlook, which was also raised. Shares initially popped pre-market 7%. They're now down 7%. Joining us is Gina Drosos, the CEO of Signet. Welcome back, Gina. Great to have you.
Great to be here, Sarah. Thanks so much.
So the numbers are super strong. And I mentioned you raised in December. You're raising the outlook. Again, clearly the consumer is in a good place, but your strategy is also working. Talk about why you are seeing these better numbers than you had even expected.
Well, I think it's a couple of things. We've been on a transformation journey for the last 4 years, a cultural transformation where our team members are more engaged than ever before. We're bringing new and innovative ideas at a faster pace. Also a strategic transformation. We committed that we wanted to be the jewelry innovation leader, and we are. We are now able to serve our customers whenever, wherever, and how they want to shop. A great example of that is that during COVID, we added new capabilities like buy online, pick up in store, curbside service, same-day delivery. These capabilities delivered twice the sales this year as they did last year. So our strategies are really gaining traction.
And I know you mentioned that you were continuing to see strong sales in January. I guess the key question, Jenna, is how sustainable this kind of growth is.
I think our competitive advantages are growing. For example, we are a highly vertically integrated company. We are, the retailer in the U.S., the U.K., and Canada, the markets where we compete, that sources diamonds directly from the mines. We have our own cutting and polishing facility in Botswana, which is operating more successfully than it ever has before. We have a diamond marketplace where we have access to over 2/3, up to almost 3/4 of the world's diamonds. And so we have a scaled capability to be able to offer our customers the very best merchandise on trend, in style, fast turning, while also being able to offer them a great value. So we've been broadening our price points, really tiering up into accessible luxury, also offering great value at lower price points. And this is resonating with our customers.
What are you seeing from consumers right now in terms of buying in stores and malls and online? There was a lot of skepticism around your digital strategy, which is a pillar of what you laid out. Are those sales continuing as people come out post-pandemic or out of the pandemic?
Sure. We saw a return to brick and mortar shopping over the holiday season. So our traffic was, improved versus year ago. In fact, in the last 2 weeks before Christmas, it was almost at 2 years ago levels, which is really quite a recovery on brick and mortar. But our digital sales have remained very strong. We saw our e-commerce sales up almost 18%. They're up 85% on a 2-year basis. So the hundreds of new features that we've been adding every quarter to improve our checkout process, our search and browse, all of those are things that are resonating with customers. And in jewelry, I think it is a mistake to think about it either as a brick and mortar business or a digital business. For most customers, it's really both. So we're seeing customers have multiple touch points with us. And so now our optimized store footprint, which is still, quite broad, really gives us a strong competitive advantage as we add all these new digital capabilities as well.
What do you think is going on with the stock here, Jenna? It's down 7.5% on everything you're saying. Sounds like good news and should be well received. I know it's had a big run up, but any concerns you're hearing about investors, or what do you think the market has wrong here?
I think we saw some profit taking for sure. Our stock is up more than double in the last year and one of the best performing retail stocks. And so we see some hedge funds taking some profit. The fundamentals, though, are very sustainable. I'm very pleased, for example, with the share repurchase that we announced today. Our balance sheet is very strong, not only because of the high sales, the improved operating margin, and so therefore the higher profit that we generated through the holiday season and that we guided to for the full year. But because of some of the inventory and working capital improvements that I talked about, we have a lot of cash to be able to deploy. We made 2 great acquisitions in the last year to help grow our business, Diamonds Direct and Rocksbox. We invested in digital capabilities for our own business. We invested in talent and our people. I think we'll look back and say 2021 was the year of talent in the history of Signet. And we're able to return cash to shareholders. We announced today a $500 million addition to our buyback authorization and a $250 million buyback. So while we think the stock is at a good value, we're able to make sure that we are giving cash back to our investors through that kind of an accelerated share repurchase.